Gold and silver markets closed in the red this week. Recent spot price weakness has been attributed to significantly lowering crude oil prices, with some blends down over 20% in price over the last 5 weeks or so. As well, US dollar index strength has now blown past levels not seen since the summer of 2017. Gold closed the week around $1,211 US dollars per troy ounce. Silver finished around $14.22 per ounce. In industry news, two noteworthy events occurred since our last Metals and Markets wrap. The Bank of England reportedly denied Venezuela's recent request to repatriate gold bullion reserves it holds in London, citing concerns that the Maduro regime would simply use said gold for itself and not the Venezuelan citizenry. On this reported Bank of England denial of Venezuelan gold repatriation, one must consider the larger ramifications for other nations such as Bolivia, Ecuador, Brazil, and India, all of whom currently store large gold reserves in London as well. This past Monday, November 5th, Republic Metals Corporation, one of the largest bullion refineries in the United States, declared bankruptcy. The closure of Republic Metals Corporation will certainly add to supply-side pressures in the U.S. bullion industry, and may be further exacerbated if silver and gold spot prices continue to fall in the weeks and/or months to come. Both ongoing stories were and will continue to be covered on the Silver Doctor's website. We will be right back with this week's guest. But first, we have a limited time silver bullion coin offering from the Perth Mint in collaboration with SD Bullion.
SD Bullion and Australia's famed Perth Mint are offering silver investors a free 2019 Perth Mint Silver Kangaroo Coin. Only while supplies last. When you purchase 24 brand new Perth Mint Silver Kangaroo coins, you'll receive the 25th silver coin for free. These 2019 silver bullion coins will come officially sealed and delivered in protective Perth Mint tubes. Visit sdbullion.com/free to claim this limited time offer.
This interview was recorded November 8th, Thursday at 4 p.m. Eastern.
Welcome to this week's Metals and Markets Wrap. I'm your host, James Anderson of SD Bullion. With us this week is a new guest to our podcast. He is Mr. Michael Oliver of Momentum Structural Analysis. Michael began his financial career working in the gold market in 1975, and that was the same year U.S. citizens were allowed to start saving in gold bullion again, and as well, in 1975, the COMEX began trading gold futures contracts. Michael began his study of gold and financial markets under David Johnston, the then head of E.F. Hunton's commodity division, who later became the chairman of the COMEX in 1981. For the past 26 years, Michael has been running a financial firm, Momentum Structural Analysis. Michael, it's good to have you on our podcast.
Oh, great to be here.
Michael, before we jump into the current ongoings within financial markets, and specifically precious metals, I want to take you back to your early days trading in gold. Can you give our listeners an understanding what it was like, from the cyclical bear market low of $100 an ounce gold in 76, all the way up to the $850 price spike in late of January 1980?
Sure. I was hired by Hutton in April of 75. Gold had been legalized in January. And they started trading on the COMEX, and my boss was, like you said, was the chairman of COMEX actually at that time on through 1981, which is during the Bunker Hunt crisis in 1980 when silver collapsed. But I remember the bear market low because I happened to be next to the pit the day it occurred, a sheer accident. And I remembered the day so vividly because one of the floor brokers down there was trying to sell his services to Hutton to execute trades on the pit. And Johnson sent me down there as his agent and talked to the head of the floor brokerage firm. And that was in August of 1976, and the low was actually $103.50. And at that point, most of the floor brokers who thought the introduction of a gold contract would just be great for business were really down because as soon as it was legalized, it topped and it went down for the next year and a half to $103 from a $200 high. And they were really disappointed because volume was terrible. That pit that day, I swear, there were two guys not standing, sitting around the edge of the pit, waiting for orders to come in. It was that dead, and this broker was just really eager to get some business from Hutton, even in a dead market. So that says something about depression, emotional depression in markets when you feel like, gold's gone through that recently, I think, the last year or two, in fact, a prolonged period of, geez, is it ever going to get going again? Our view is that it will. But anyway, that was the sentiment at the time. And of course, at that point, it turned up and continued to plow north until 1980, where it went to $850 an ounce. And there were many times during that bull trend where government action, IMF action, would dump gold into the market, announced IMF gold sales. And they tried to stop it. It was Jimmy Carter was president back then. And of course, they didn't. So that was a time period where a lot of the central banks and the IMF, but it not necessarily was the motive behind their gold sales, but they definitely wanted to try to stop it, and it did not succeed. You would have occasional sell-offs due to their sales, and quite sizable amounts too, of quantity of gold they were selling, but it didn't stop the bull. It peaked on its own volition when it got to 850. It said, that's it, okay? And then we had the big correction down into the 200s, high 200s that lasted for a couple of years. And then we had the other bull move. They went to 1900. So it's anyway.
Of course, I'd be remiss if I didn't ask a little bit about the hunts. From the research I've done, it seems like they got somewhat scapegoated. Obviously they were really involved in the silver market. I'm sure you've heard stories and such. But it looks like they more or less just changed the rules in comic silver trading, and people couldn't even go long. So essentially, if you were in the gold pit, you looked over and you're thinking, well, they're going to do that to us next. But the weird part about it is that all four precious metals within months all hit nominal price highs. So you first had simultaneous gold silver, January 21st, 1980. A few months later, both platinum and palladium as well.
Correct. But it makes sense that they would go as a group, and they were all, reaching excessive levels for that swing, and that's what markets tend to do. It's technically speaking, they'll overshoot their value on the upside, and they'll overshoot a reasonable value on the downside. So they'll oscillate the mean, as it were. I was not with Hutton at that time. I'd left in 1976 and gone out into the retail market as a futures broker. But in 1980, the rules were changed so that, he was saving, David Johnson saved the Europeans who were getting skewered by being short silver. And it killed Hunt. Probably would have killed him anyway, because that market, frankly, at $50 was, it had gone from $3-4 an ounce to 50. So what do you want? Bunker Hunt was interviewed in Commodities magazine back then when it was approaching the $50 level. He said it's going to 100.
Yeah.
Of course, everybody thought he knew what was going on because he was the king of silver.
Right.
He wasn't.
And the other point was he was like half physical and half leveraged, and he was using leverage like a moron. And then when it went wrong on him, his face got torn off, basically.
Mm-hmm. No, when they told him you can't sell that many today, and they can't take your order, he panicked. Well, it killed him almost, and then later it did. But anyway, interesting times. It's a new game now. It's not just personal. Of the one guy, an oil guy, who learned about silver because a floor broker told him about it, and then got his business. It's now, and I don't say this because we have a new gold letter that we've issued. MSA has been in business since '92, primarily providing unique technical research for institutions. About 4 or 5 years ago, we opened it up to investors, high net worth generally, because we charge quite a bit for our normal report, more than most market reports. But we decided a few months ago, because of my perception of what gold I think is about to do, to issue a report that's just gold, silver, and miners, and for a reasonable price, something that most people could afford. Why did I do it? Because I really do think, no hype at all. I could have done this at any time in the last 25 years. We've had some bull markets, as you know, in gold. This time I think we're headed for the last bull market in gold. And why do I say that? I think the next bull market in gold will be a reflection of and expression of a major crisis that's been in the works for decades, building and building. Probably you could mark maybe Richard Nixon's cutting off the dollar from international exchange for gold in 1971 as maybe the beginning of the fiat currency orgy. And ever since that time, the ups and downs in the stock market in most markets have been like oscillations that you see on a screen, but they get higher and lower each time, so that each disaster gets worse and worse, and they come in with the same solution, quote unquote, each time to create a new bubble to save from the old bubble. And the amplitudes are getting disastrous, and I think this next one will be so cleansing, will be so big that they can't stop it. They can't do anything to protect. In 2008, they came in and probably stopped the hemorrhaging for a while, and the market was oversold anyway, stock market in particular. And they think, therefore, they succeeded. But the next one is going to be far worse because it's not a stock market event. It's both a bond, a stock, and a commodity event. And I think that on the upside, there'll be few, but gold and silver and the miners will be the leaders. The area where most people are still yawning about over the last few years and still afraid of. I think that's in the process of shifting. I think one of the things that will help shift the investor sentiment is the further rattling of the stock market. And we firmly believe, based on technical analysis, not on our fundamental assumptions, which we put off to the side, that stocks have seen their high. Developed markets in particular, not necessarily emerging markets. They're a different category. We're more positive on them. They're more commodity related also. But we think the stock market's peaked. And I think if you take away this rally they've recently had and you do it in the next couple of months, I think investor sentiment's going to start to shift more and more. And you know what they do? They go find something else. If gold is upticking during that time, and we think it will be, that's one of the places they're going to go. And then a year down the road, they're going to realize that really was the place to go. And the more and more will pile on. You know how it works. This is how it happens every time. And so that's our expectation. And again, it's not fundamentally driven. We understand the reasons and so forth behind each of the bull markets in gold. But we think this one is an expression of multiple crises across asset categories. And gold will be one of the prime, if not the prime beneficiary.
Yeah. Now, Michael, I want to take you back just real quick from not just, currently what's going on or what's moving ahead. There is a great trade that you made on the 1987 stock market crash. Can you explain to listeners how you were able to successfully identify and even profit from that?
It was technical.
Yeah.
We ignore price. Not really we don't put it off the page entirely, but we treat it as a secondary technical thing to look at. Most people start with price, and maybe they put a few bells and whistles on it, like MACD or RSI, these things you get free on your screen, you know what I mean. The reason we don't trust price as a great yardstick of measuring the technicals of the market is that price is an expression of a fiat currency and that asset. It's not just that asset measured by some objective yardstick. You measure it in dollars, euro, yen, etc. And all these currencies, especially since Nixon's time, have been inflated at a more or less constant doubling of the currency every decade. Now, for instance, you can get an M2 chart from St. Louis Fed. Go back and look at it. It's basically doubled in quantity since 1959. Every decade, it's cookie cutter. Almost doubles every 10 years. Well, imagine a yardstick. You're a contractor and you're building a home or an apartment, and you use a yardstick for your measure of length and so forth. And that yardstick grows every month, let's say an inch or two. So it takes you 6 months to build this house or apartment. And your yardstick has grown each month, but it doesn't say it's changed. It still says 36 inches. Now, if obviously that kind of metric couldn't be used in the real world, the buildings would crumble. Well,
correct.
Fundamentalists who measure things like earnings, which are in dollars, this year versus last versus the prior, or overall sales, or a lot of things in fundamentals are measured in money units.
Sure.
Well, there is, over a period of time, the distortion gets worse and worse because the inflation in the money unit, not necessarily the CPI, but the inflation, meaning the expansion of the money supply. We've had 4,600% increase since 59. So that kind of expansion means you have a unit of measure that is really, over time, is worthless.
Yeah.
Now, you can try to compensate. A lot of people say, well, look at the CPI and factor that in. Well, we know those government metrics don't really compensate for the money growth.
Correct.
So what we do is we measure price in its relation to a mean. Famous Bob Farrell, the chief technician at Merrill Lynch back in the 70s, his first investment rule was markets tend to return to the mean. And we all know that over time. Most people like to ignore it, but it's a truth. There's also a truth that we assert, and that is markets also tend to oscillate the mean. So, but if you measure price in relation to a moving average of price, and I don't mean lay the moving average on the price chart and look for crossovers. To that's meaningless. What we measure is the distance of price from the moving average, and we oscillate it, put it on an oscillator. And when you create a momentum chart in that way, which we do on all time scales, short-term to long-term, you see a different trend structure than you do when you look at the price chart quite often. And momentum usually will break out upside or downside well before you can find that breakout on a price chart. So we emphasize momentum analysis, and particularly the structure of momentum, just in the same way that people who look at a price chart draw lines.
Sure.
Doing what? Defining structure, uptrend structure, sideways structure. We do the same thing, but with momentum. And we think it's a far better filter, and to some extent, it distances us just a bit from using straight price charts and having a distorted metric. So that was a brief, but probably in more depth than you wanted. But that's how we function.
Well, there's just speaking of price charts in general. I mean, I know just analyzing some of the comments out there, various people, when they hear technical analysis, a lot of them will point to it and say, look, we live in a world of manipulated fiat currency values, interest rates, et cetera, central bank driven financial markets. And they think, just kind of toss your technical charts. Who cares?
Mm-hmm.
I mean, when you obviously your methodology has much more depth there. I mean, how has this helped you and your followers over the decades? How does that, thinking it's a fool's errand, kind of run roughshod over your idea?
Well, fortunately, our reports on the major markets, we examine all four asset categories: stocks, bonds, foreign exchange, and commodities. So we look at everything all the time, with emphasis like in commodities on gold and oil and so forth. But our record is documented because our reports are filed away and so forth. But you can go on our website, olivermsa.com, and there's a methodology tab there, and you can go to the bottom of it and click on there's a PowerPoint that shows all of our calls on the S&P since 1994 through 2011 anyway. And we call every major top and bottom, often before the actual drop becomes evident at all on the price charts. In the same case with gold, for instance, though we hold a long-term bullish view on gold, we also know there's also long-term of a couple of years when it can go down big. And so in 2011, when it hit 1920, by early 2012, January, February, it was still hovering in a range from the upper 1700s to the lower 1500s, going back and forth like a trading range almost. People thought it was a shelf, prior to going higher. We said, no, it's a major top. And we did that based on annual momentum of gold breaking structure. Very clear. If you looked at the price chart, you couldn't see it. You could make up that argument of it's just a congestion zone prior to the next major leg up. But momentum said, no, you're dead and buried. Well, it took gold a year and a quarter to finally collapse. But in April of 2013, it went from the 1700 down to under 1200 in 3-4 months. And that was effectively the bear market all compressed into those 3 months. Then again, it took it another couple of years to finally make its last little bottom, but it zigzagged down another $150 over the next year and a half. And then we called the upturn. We called it at a level that didn't make any sense when you look at the price chart. It was 1140. And when you look at a price chart in February of 2016, it was off the low by $90 or so. And it wasn't breaking out over anything, but momentum was blowing out through a massive overhead structure that had it been a price chart, everybody would have seen it and jumped on board. Since that call in February 2016, with price just above 1140, we've not changed our view. There's been nothing that's happened on long-term momentum of gold that alters the view that says that was a major low and we got well off that low and we've congested since then, mostly in the upper 2/3 to upper half of the price range from that late 2015 low to the summer 2016 high, which is like a $400 move plus. Most last 2 years or so, gold's pretty much stayed in the upper half of that range. Meanwhile, silver and gold miners have gone back down deeper, and silver went back to the low. And the gold miners went back down, to $17 on the GDX, for example, whereas its low in 2015 was $12 and something. Now it's trading 19 to 20. But it's been a laborious period the last 2 years. But our long-term view is that that was the low, and we are going higher, despite the recent congestion. Much like, reverse the picture, once we made the high in 2011 and dropped into 2012 a bit, went into a range for what, a year and a quarter. This one's been longer, sideways. Nothing in that range that tried to go up convinced us that it was going up. We viewed any rally at that point forward, from early 2012 to early 2013, as baloney. It's not going to lock and load and go up. It's just a fitful rally trying to impress people. And finally, it did collapse. Well, we reversed that thing now. We think that this sideways action we've had since mid-2016 is preparation for the next leg up, and we think the next leg up is probably very soon.
Wow. So as far as gold and silver at the moment, I've heard you speak about gold just now. It sounds like you are pretty bullish in the near to medium term. What about silver? What are you thinking on that side?
Well, we think silver is going to outperform, and so do the gold miners, outperform gold in the next major up move. If you stand back and look at what both of them did from the 2015 lows to the mid-2016 high, gold went up X percent, $400 almost. But silver and gold miners vastly beat gold in that surge. I mean, there's no comparison in the percent gains that silver enjoyed and GDX enjoyed. Similarly, on the downside, since that peak in mid-2016, gold's pulled back less, while silver and gold miners have dropped more. So they both tend to act like dogs on a leash, fitful little dogs. Okay? They swing wide. And so we argue, and we also have done spread analysis of gold miners versus gold over many years. And that spread, despite the recent pullback in the relative performance of the miners compared to gold, it still looks positive to us. Like the next leg up is going to occur, and GDX will and gold ETFs, gold miner ETFs, will do better than gold will. Similarly, I think silver will outpace gold. However, that may not be true in the in other words, the next $50 in gold. You may not see that in those two other sister markets.
Right.
But you'll see that further on down the line. So I argue now that the better place to be is fishing around in the GDX and fishing around in silver. Measure gold. You've got to, because it's the mama. But it's probably not the best percent gainer over the next couple of years.
Can you explain a little bit about this general gold and silver mining research offering that you guys have? Can you explain a little bit differentiation that you may have versus others?
Well, we narrowly focus in this report, and you don't get bond analysis and stock market analysis and forex analysis in this. So it costs less. It's $299 a year, but you'll get 2-3 reports a week, and we'll update gold. We just sent out one today, updating short-term gold and long-term gold charts. But you always get, usually in the weekend, you get gold, silver, and updates in the key miner ETFs. And then we also go down inside the GDX, for example, look at its holdings, examine each stock and GDXJ, the juniors, and look for picks within those ETFs that might outperform the ETF itself. In other words, which are the likely better performing miners. And we don't want the ones that, for example, that may have already been quite firm. There are a few of them that actually didn't suffer much, like GDX did. We don't want those. We want the ones that have suffered, have gone down, paid their dues, and look like they have the best technical wherewithal to generate a strong initial up move. And we can generally tell that by looking at the nature of the momentum bottom they've created. Again, not looking at the price chart. And you'll see a structure that an amateur could look at if you were looking at the momentum, would say, wow, that's a good looking bottom. And you might not see it on the price chart.
Right.
But we call out the ones that have the better looking dynamic bottoms such that when they break out, they're likely to really rip. Mm-hmm. And therefore we've come up with, like a 5 or 10 in the GDXJ and about 5 in the GDX that we think are the better picks. So that's part of the report as well.
So, Michael, I don't want to take a whole huge amount of your time. I want to conclude with a couple questions just to cap off our opening discussion here. We obviously have valuation bubbles in various asset classes, and even in fiat currency values. I think both you and I would argue. We got record global debt levels that keep happening quarter after quarter. likely is going to be some restructuring ahead. Some will be written off, some may be inflated away. I'd like for you to describe how you believe this coming bull run for precious metals may culminate and how it may ultimately end.
I have not got a price level in mind, except to say I think it's going to be stronger than anything I could come up with. The long-term charts don't give me a clue on that right now. Prior bull market peaks did make some sense where they stopped and so forth, for instance, the 2011 peak. But so I can't come up with the numbers that were going to $10,000 an ounce. I can say that I think that because of what's going on in the other markets, forget gold for a minute, what's going on in the government debt markets, developed market economy debt markets, they've been the most distorted assets over the last 6 to 10 years of any asset I've ever seen manipulated by central banks. And fortunately, if you're a gold bull and you believe, for example, that ignore technicals because, the markets are manipulated. Well, frankly, yes, they are manipulated. We know that. They may even be manipulated in secrecy in some ways as well. But that's what central banks do. They distort prices deliberately. They don't allow the market to determine what price or what yield the Italian bond should be. So the ECB comes in and buys Italian bonds until their yield goes down to some absurdly low level, even below U.S. government bonds. And we all know that's ridiculous.
Right.
Japanese government bonds went to negative rates. We know these things are fake. We know they're manipulated overtly, legally, by coercive actions of central banks. But this time they've done it over such a long period of time, not just a year or so, but 10 years. And they've done it to levels we've never seen. We would not have even imagined a decade ago that you could go to, NERPS, negative interest rate, or ZERP, zero.
Right.
That would be laughable. But they did it. And therefore, we know that the distortion was both more absurd than it before and also more prolonged. Therefore, the consequence, the unraveling of that, the accidents that will occur because of that is going to be far worse than it would ever have been. Therefore, gold is going to be powered this time by a greater unraveling than it's ever been powered before in other prior lesser unravelings. And I think this is the one also that will bring probably a destabilization in political trends as well. If in the past bust we've had, it's not really disrupted the politics in terms of, how do governments view how does the public view central banks? How do politicians view central banks? There are, after all, in Europe, for example, and in the US, some people in political power, especially in the Senate, like, Rand Paul and Cruz, for example, or in Europe that are rising, ascending and knocking the Merkels out of the way, that have a different view of fiat currencies. And they don't particularly like what the ECB is doing. And they don't like what the Fed is doing. And there's probably even Japanese, I'm not aware of them, who don't like what the BOJ has been doing, owning the stock market almost as well. Sure. So those forces will likely rise, and they'll have justification, and it'll be publicly aware, because I think the public is a little more aware of this now than they were before. In fact, a lot of your customers, I'm sure, are. Yeah. That this needs to end. We need to go back before Nixon, and we attach currencies to gold. And what have the Chinese been doing? I think the Chinese have been accumulating gold with that in mind. I'm not so sure that Putin isn't doing it as well. And there are forces in Germany. They've been repatriating their gold right and left over the last 5 years or so, bringing it back from Fed vaults and Paris vaults, bringing it back into Germany. Why? Do they see a need for it down the road? I think some people see that. And I think, therefore, the next crisis will bring about political events and changes with new personalities and mindsets that will bring gold into institutionalize it again, back their currency, in which case gold could basically, the next bull market peak, it could sort of just stay up there.
Right. Because
it's convertible in currencies. You don't need it anymore almost, because the dollar might be backed by gold. It'd probably be the last one.
Right.
But the yuan probably will be, and perhaps a new euro will. I don't know. But the crisis will bring that to the fore. Mm-hmm. And I think it'll bring political events into change, not just market events. Mm-hmm.
Well, Michael, thanks so much for coming on the show this week. We really do appreciate your time. Could you please tell listeners how they can find you?
Okay, it's our website is Oliver MSA, standing for Momentum Structural Analysis, olivermsa.com. That's our website, and you can tool around. You could also ask for sample reports of the new gold report or of our general research reports, and I'll be happy to send them to you.
Well, great. Thanks, listeners out there, for tuning in this week, and we'll see you next week.